here's your retirement. So let's say that, and I put this out to age 70, you can retire whenever you want, but let's watch this. So you've been putting in, according to yours, the minimum. Let's just say you put in the minimum, 18,000, not the 103 that you could be putting in. But let's just say it was just that. By the time you're 70, you've put in 481,000. Okay?
Okay.
And let's say that you want to help your retirement at, let's go here and say, well, you were putting in 18, so let's double that. Let's just go 36,000 a year for the rest of your life that you want to borrow out. So we scroll down here, you'll notice that here where it says end, basically it never ends. So you could pull out 36,000 a year tax-free till you're 121, no issue. So let's make it bigger. Let's go 45,000. You can still pull out 45,000 till you're 121. Let's go 50,000. You can pull out 50,000 until you're 121. Let's go 60,000. Okay, now it finally broke someplace up here.
Oh, 85.
So until you're 85. And why that's happening at age 85 is that the cash value, which will continue to grow even though it's RPU'd, and you understand RPU, reduced paid up, is an insurance only offered to whole life policy, and it lets the policy owner stop premium payments. So you stop premium payments at age 70 in this scenario, maintaining a fully paid up policy with a guaranteed death benefit. So at age 70, you'd have a death benefit of 1.9 million. And I'm saying here that you're borrowing 60,000. Well, that 60,000 is going to cost you that year in interest $3,000, but your 565,000 in the cash value is still going to grow, and that's what it's growing by, 32,816. So you still have a positive arbitrage that year of almost $30,000.
So my net cash value is going to go down by 30 grand if I'm taking out 60.
Yes.
Okay.
Yep. Mm-hmm. And again, that gets paid off. So let's say that you get in a car accident at 75, or you have a stroke while playing golf or whatever. I'm not trying to create a self-fulfilling prophecy, but by then you've been pulling 60 each year. So you have a note of 300,000. You've got a death benefit of 844. They would take and pay back that note, and your heirs would get 544,000. And you're still having a positive arbitrage at that age of 11,000.
So so between the two policies with Marissa and I, we could put in 103 each. 103 each.
So I've got hers here, the same thing I did for you, and then I've got the combined. So combined, if you guys followed this plan, now let's go and throw in 100 grand and see what happens between the two of you. So if you're both still alive and you want to pull out 100 grand, you can pull out 100 grand until you're 121. So let's go 125.
Wait, this is what just putting in the 18.
18 each. Yep.
So we could pull out 100 grand.
125 grand a year until you're 88, and it would never run out of money.
So if it's like 110, we could live till we're 100. And
yep.
I guess you're just playing with it.
Yeah. So yeah, at 110, it outlives you. 121. So 115. You can still do 115, 120. So it's somewhere between 120 and 125. Yeah. Oh, it is going up here. Sorry, I wasn't looking up further. So 89. So let's go back to 120. So you can make it to 90 at 120. How's that?
Okay, so
check this out. Sorry.
Go ahead.
Not that I wanted to interrupt you, but okay. So at that point, your cash value, which when you RPU'd this bad boy was 962,000, because it's continuing to grow at that 5.2%, you now have a cash value of 2.5 million. You haven't put a penny in since you were 70. That part's growing by 90, but you've been borrowing, and that part you're borrowing now is exceeding it. So you got a negative arbitrage. So 120,000. So if you died if both of you got in a car wreck at age 89, you shouldn't be driving then anyhow. and you both get in that car wreck because you're still trying to drive at 89, they pay back. You've got a total death benefit, a gross death benefit of 2.8 million. They pay back the loan of 2.4 million, and your heirs would get 428,000 tax free. And you guys have lived on 120,000 tax free since you were 70.
So then,
20 years.
so as this sits right now, like the minimum that we put in is like 18,000 each, well, 36,000. But what if for the first 10 years we put in like the max 103? Can you show me that?
I can go get a new illustration and do it that way. Absolutely.
Okay. You have to get.
But I'll just go create a new illustration. That's what this is for. That's why I built this tool, so I can continue to iterate these things for you, right?
Yeah, because after I see that, I mean, it's not. I guess it's finally clear in my head. Like, it's not a saving. It is a savings plan as a default. That's not very good because you're buying insurance,
Right.
whatever. But it is. If I use the tool as an investment tool over the next, like I put as much money as I can into it over the next 10 years, and then use it as an investment tool during that 10 years and beyond. It becomes a powerful wealth building tool.
Absolutely, because it's a bank.
Yeah. Well, so that's why I mean, from a conceptual standpoint, like really, I need to figure out how to put $200,000 into it every year,
right?
Over that 10-year period,
right.
And then see what my retirement looks like.
Yeah. And by the way, it's the exact same structure. I don't have, because I built this in such a way, Will. All I have to do is go in and make one modification to the illustration. And instead of telling it to just put in the 103 1 year, which is what I did, I can click on 5 years or I can click on 10. And so it'll just ratchet that up to the 103 max. And I already know it's going to be okay. And it'll just, ratchet the cash value up and it'll ratchet the death benefit up. So it'll just be monster.
Yeah. So what is, I guess my question is, so what does that look like? You can't change it.
Not in here. I have to go make you a new illustration, but I can go make you a new illustration and come back and show you the spreadsheet again.
With your spreadsheet, you can't, if you change the gross premium annual, it doesn't reflect down on the bottom.
What I don't know, I could put it here and it would increase it here, but it's not the illustration. And because I don't want to mislead you, I want to actually have the insurance, because all these numbers, you keep saying the term conceptual, and I understand that because you're an attorney and you think that way, and I haven't corrected you. But the reality is this is guaranteed. These numbers that I'm pulling here are off of the illustration, right? This is what the insurance company is saying. If you put this in, this is what you'll have in year 72. This is what you'll have in year 75. So this is their actual illustrated numbers. This isn't
okay. Guaranteed numbers.
Yeah, this isn't like an IUL where, well, it's dependent upon the market averaging 5% per year. I mean, these guys have been paying 5 to 6.5%, 4.5 to 6.5% now for 40 years.
Right.
And they're going to keep doing that. Oh, and that was a point that I wanted to make earlier when you were talking about that, is that, remember, this is a mutual company, right? So as interest rates go up and they charge more in interest, who gets the benefit of that?
Yeah, goes to the policy owners. What?
Exactly. And we are the policy owners. And so as the company makes more money because interest rates go up, we make more money as the policy owner. So yeah, 5.2 could turn into 5.6. But again, these guys aren't playing Russian roulette like the banks and the stock-based insurance companies play. They put their money into assets. The only one I know of, because I don't get into their portfolio, but I mean, I understand the idea, but like the city that you helped us get that house at there in Clinton.
Buy bonds.
Yeah,
municipal bonds.
Right. The city wanted to put in fiber optics. So the city went to an insurance company, they put up a bond, which guaranteed the insurance company that they'd get paid back. Yeah. And then that's where they got their cash to pay the contractors to dig up the streets, put in the PVC and blow fiber optics through the city of Clinton. Mm-hmm.
Yeah, this makes a lot of sense. I can see for business owners how it makes a lot of sense too, especially if they figure out their cash flow, the cash flow needs.
Well, and I've got that also as a spreadsheet, and I would obviously share that with you. But let me just pull one
But
up.
you showed it to me with the one.
Oh, that other guy, yeah. So I've
Right.
got, yeah. This is just a, husband wife team. That's what I've built this one for. But I've also got one for the business owner that wants to show, what they're bringing into their business and cash flow it that way too.
Yeah, I do. I guess I finally see what you're talking about. Like, yeah, I just want to put everything into it. And what I use, I guess that's
Right. You put it in, and you pull it right back out. Who cares?
yeah. But okay. Yeah, this is amazing.
But here's another point though that we hadn't talked about. So this is still your real one. So you guys, under the current scenario where it's only 18 a year, you've put in 962 combined, and you've turned that into 2.8 million by the time you're 90 years old.
As a death benefit.
Yeah. But you're going to get it because you've borrowed back 2.4 million of it. Okay, so if you just look at cash on cash, you put in 962 between now and 70, and you've pulled out tax-free 2.4, which we just said would probably have been 3.2 to earn that much, and you're still giving, that's tax-free, and you're still leaving your family a death benefit at age 90.
Right. So there's not really a way, just like, let's just suppose someone had like say for instance, someone had $3 million, right?
Uh-huh.
Is there some way to set this up where they don't have to keep paying on an annual basis, or they have to pay for
Absolutely.
it?
No, that's the thing. That's why I structure these depending on what they want to do. So you can do a two pay. So if somebody had $1 million and they just gotten it from an inheritance or something like that, you can do a two pay where they put $500,000 in here, and at day 366 they throw in another $500,000. For the IRS's purposes, it has to pay for the first 7 years, but it just pays out of the interest that it's earning. So it's a ghost payment that's coming out of the interest earned years 3 through 7, but all they're putting in is $2 million, and it just continues to grow.
I see. Okay. Yeah, no, that makes sense.
But when you say 2 years, it's really 366 days.
Yeah, this is fascinating, actually. Okay.
Yep.
Yeah, I can see the, I can see the value. Okay, this is now that you've showed me this, and I've got my head spinning around. Like, I mean, you showed me the roofer thing, but conceptually, I mean, I understood it, but I can see, like, if you can get a business owner to put in essentially $20,000 a month.
Yeah.
Then it turns into not only their retirement plan, but their transition plan.
Yeah.
And it won't affect if they have a cash flow issue. It's really a non-issue. I mean,
because they come back and borrow against it. Yeah, that's what I told that roofer. I think I told you this. That roofer, when he and I started talking, so it was another gal that I do these with. She's the one who introduced me to him. We get on the Zoom call, and the first words out of his mouth, he calls her by name and says, "Look, I know I told you I'd get on this call with you, but I've been thinking about it. I really think I've got enough life insurance right now. The most I'm willing to pay more is maybe another $150 a month. So just figure out what it's going to cost me, how much more insurance I get at $150 a month, but that's all I'm willing to do." And kind of scoldingly, she says, "Wait a minute. Eric's time is precious. He's very busy. You promised me that you would give him half an hour. Please just listen to him for half an hour." At the end of that half an hour, his exact words were, "Are you sure I can only put $15,000 a month into this?" Because the light bulb went off. It went from, "I'm not going to buy more than $150 worth of insurance," to, "You sure I can only put in $15,000 a month?"
So how can you explain this? That's what I'm thinking is, like, what are the words to the business owner? What are the key words? Because basically, like, it's not clicking in with life insurance or a savings plan. It's like
becoming your own bank.
It's becoming your own bank, but like, that's still kind of a
vague term.
It's who thinks through the process of being their own bank?
Well, that's the problem. We've all been taught that we can't. We've never been told we're able to. So here's how I begin my presentation that I give every week with this.
Getting cash, it's getting your current revenues and your future revenues working for you to fund your retirement.
Here's what I say. I throw up this one that says, many people fail to realize they have the power to control their financial landscape. And I say, just like Dorothy in The Wizard of Oz. And then I tell them, by the way, that movie was written about the banks, right? And then, so Dorothy always had the power to click her heels and get back home. Well, mastering the control of the interest that you're paying on things is the most lucrative endeavor you can pursue throughout your life. Private equity banking is about recapturing the interest you pay banks for the major items you purchased during your life. Like you just said, oh crap, I just spent $30,000 on cars. I should have done that myself, right? Private equity banking does not involve any form of investment, but instead how you finance the things of life, and this can include investments. So in your case, you want to go use that to buy another investment home. But the private equity banking isn't the investment. The home is the investment. That's where you're putting money at risk. The bank is just the vehicle or the tool that you're using to be able to go out and invest in more properties.
The fact that you can have the value of the money that you use to invest grow and have your investment grow and then return the positive back to your bank and have that continue to grow. Like it's like a trifecta, right? It's a win-win.
There's a reason why banks have the largest buildings in every downtown metropolitan city.
Yeah.
This is why, because you're now becoming your own bank. Private equity banking.
I get it. I see why. So from my standpoint, if we could show business owners, if we could show that, and it's also I think once someone puts this in place and like really conceptually understands it and then starts to do it, like to know that you're going to earn interest on the value of your investment. Then when you borrow that money, you're going to earn money, you're going to earn interest on what you borrow, and then you're going to pay that back, and you're going to continue to earn interest on what you borrowed. And then once you've paid it back, you still have the asset, you still have the original principal input, plus you've earned interest, plus you've earned the gain on whatever project you've done.
Yep.
It's kind of amazing though when you think about it.
Just a second.
Yeah, send me your slides so I can start figuring this out. I think I want
I'll
to
send
sell
you
this.
the spreadsheet.
Yeah, so I think I want to try to use my own words to explain this thing.
Well, I'd love to hear you choose it. You're the one that's a financial guru, not me. I'm just a dumbbelly. I got an MBA. I don't have a degree in finance.
I don't think so. I think you're pretty intelligent when it comes to this stuff.
Well, I don't have a degree in it like you do. But isn't that amazing? You've got a degree in finance, right?
Yeah.
And you were never taught this.
Never. I mean, I remember taking college calculus and listening to an Asian teacher talk about a Roth IRA, how you could grow tax-free and then take the money out tax-free. And he was like, and it's broken Asian English.
Yeah.
It is a gift from God. And what's funny about this is I actually understand, for my own research, just understand more of the banking process, like just how ridiculous it is.
Right.
And I've always thought, one of the best investments would be to start a bank.
Right.
I mean, where else could you put $3 million in and then lend out 30 million and then lend out another 30 million based on the cash flows coming in from that, right, the first loan, and keep doing that forever.
And now we get back to the trust. And this is something that you had already said, your exit strategy.